Welcome back to the Barclays Brief. It's a bright morning here in London, but I've been thinking about how foggy the short-term outlook for markets feels right now. Headlines are shifting fast, and it's easy to focus on one part of the picture at a time and then lose your perspective. Because beneath the more negative headlines we're seeing, a largely acyclical investment cycle driven by AI, but also energy and defense, is gathering momentum. And the scale of capital being deployed here is enormous. Taken together, this points to something way bigger, a step change in global capital spending. So the question is, what does that bigger picture tell us? I'm Patrick Coffey, and sitting opposite me today is Christian Keller, our chief economist in our research business. He's just published a chapter called Supersize Me as part of our global outlook. Christian, thanks for being here. Great to have you on.
Thanks, Patrick. Thanks for having me. Good to be here. It was a tough one to get out, the global outlook in volatile times like this.
I'm sure. How many rewrites did the front cover take?
As geopolitics moved on, we had to adjust it a few times.
So, Christian, I was rereading that chapter of yours, Supersize Me, on the train into work today. And in it, you argue that we're at the early stages of a major investment cycle in advanced economies. That kind of feels a bit optimistic to me. So what gives you the conviction that we're about to enter a new phase of much higher infrastructure investment?
That conviction in part is driven by the fact that, when you look at investment cycles, you really have to think of longer time spans. We looked at 150 years of UK and US data. And what you see is that while investment is very volatile, it does come in cycles. Typically, 10 to something year cycles that you see an acceleration of investment. And typically that is associated with somehow new technologies where companies and economies need to invest in something. It is certainly punctuated by wars, financial crisis, and these type of disruptions. But ultimately what dominates is that kind of new technology and investment that comes with it and the reorganization of an economy.
Around that new investment, yeah.
Exactly.
And so by new investment, you're talking about AI, presumably.
Exactly. In this case, I'm talking about AI and also all the infrastructure that comes with it. So the energy needs, but also the investment in IT equipment, etc. as AI becomes a proper general purpose technology and diffuse it throughout the economy. And then a bit separate, there's the defense cycle. I don't know, but we talk about it separately.
Well, we'll definitely talk about that, I'm sure. Okay, so there's lots to cover here. Let's start with AI. Help me put the hyperscaler investment cycle into some context. I find as I get older, I'm increasingly drawn to historical analogies. I've been reading a lot about US railroad investment in the 1850s, the Apollo space program in the 60s, and the telecoms boom of the 90s. So where does the AI Capex cycle really sit in comparison to those Capex booms?
Yes, I think historical comparison is actually a very useful tool because it offers perspective. As I said earlier, we have around 150 years of data. And the interesting thing is, if we look at the US hyperscale investor this year, you get about to the average annual investment that was done in the US during that railway boom you just mentioned. So we are in that category. And that is one of the biggest cycles. It's way bigger than the Apollo space program, a highway program in the US in the 50s to 70s. And it's also actually bigger than the telecoms already in some ways.
Is there anything else in history been bigger than this AI Capex boom?
Well, we have some interesting artifact. We found that there was a purchase by the US of the Louisiana territory. So there is a bigger investment if you want to count that. But, frankly, that was very particular. We threw it in there just as a comparison. But as I said, AI is now up there with the railroads. It should be a pretty big boom.
And can you just put some numbers around that investment relative to other cycles for us?
Yeah, look, when we look at the build-out of the US railroads, we have that as 2% of GDP, and we think that's about where the US hyperscalers end up right now when we look at the committed investments.
Okay, and that AI investment, is it adding up to a sort of notable increase in aggregate investment for the entire economy, or is it more of a reallocation of investment?
Yeah, that's a very, very good point. And, we don't want to be naive here. For example, if you look at just the fourth quarter of GDP data last year, actually overall investment, despite very strong AI-related investment, wasn't that strong. So there seems to be some replacement going on. However, over time, if you see AI as a technology that needs investment, as I said, not only in the AI itself, the data centers, but then also in other equipment, AI-related, and in the energy, it is likely to be additive. Not 100%, there'll be some offset, some replacement, but it's hard to see that you have such a boom that would then be fully offset by reduction of investment elsewhere.
Yeah. And clearly AI is the most visible part of this whole story, but your work suggests it's only one building block. How important and interlinked then are energy security, defense spending, and economic resilience in turning this into a kind of broader, more durable Capex boom?
It's important to also to see that we are looking at this kind of as a cycle in advanced economies. And I think the regional distribution is not fully equal. So the AI is particularly done, hyperscaling is particularly done in the US, the data centers. When it comes to defense, we see Europe as a region that has not invested much in defense. That's clearly coming back. But putting into context, well, if you look at general purpose technologies, it's always that you have a core investment, in the 90s was computers or so, but then you have a lot of investment around it. We see it now already, what we call the, AI-related IT equipment investment. And then you have the energy. And the energy is largely, to provide the electricity for the data centers, but there's more going on. There's a general electrification. There'll be a lot of investment needs in grid technology, et cetera, for the electrification that's coming independently of AI. I think those two are together. Defense is somewhat independent, even though the reality is that a lot of the defense will depend on AI. There's probably some interlinkage there as well.
Sure. Just coming back, you mentioned advanced economies. Why do you focus on advanced economies here? Why not just global economies?
Good point, because this is really where we saw, from a global perspective, the investment weakness. If you go back, we had ratios of 26% as a share of GDP, what advanced economies were investing. And that then really came down all the way to, last year was at 22% or so. On a global scale, investment was relatively stable. What happened? China. China came in early this century, obviously, with joining the WTO. Massively high investment ratios, close to 50, coming down below 40 now, still very, very high. But, you had this peak of China investment that seems to be coming off now. And as I said, after 2 decades almost of low investment, a lot of signals are now for those advanced economies, in particular US, Europe, Japan, now basically coming back up.
I see. So you've got to strip out China, focus on the advanced economies, and you're seeing, you think we were kind of at a trough last year and you expect that investment cycle to increase. You also made the point that geopolitical shocks, clearly we're talking about Iran at the moment, aren't just risks to growth, but they're also catalysts for investment. How should we think about that shift, particularly when it comes to energy and defense?
Yes, in the short run, something that is a key ingredient to all activity, oil or energy in general becoming more expensive is not a good thing. But I think what we've had also together over the last 2 decades with China is, we had a high focus of all our supply chains globally, manufacturing, energy, everything really on efficiency. There were no redundancies. Everything was just in time. And obviously with the Corona crisis, I think it came home that people realized, wow, we're just dependent on few factories in China in the same town producing everything we need. Now the ongoing crisis with energy in the Gulf is bringing home to Europe in particular that they are very reliant still on energy in certain regions. Places like China have much higher storage capacities, etc. So what I'm saying here is it probably dawns now to Europe or across the world, to the advanced economies in particular, that they need to go from just in time to just in case. And that does require investment in hardware. As I said, storage facilities when it comes to oil, larger warehousing for manufacturing goods, etc. And creating some redundancies. All this should be adding to investment needs.
I love that expression, just in time to just in case. It's worth remembering, though, that AI, energy, defense, obviously you talked about they're facing a boost in investment. They only account for about a third of all investment in advanced economies. So with that in mind, what are the biggest constraints that could limit how far this investment cycle actually runs?
Some are very obvious. I mean, defense is typically at least led by the public sector, I should say. And the public sector is stretched. And Europe, has just, to tell you the story of a country like Germany, that in the mid-60s was spending 5.5% or so, over 5% on defense, went all the way down to 1.5%, is now back to 2%, wants to go to 5%. But, Germany does have the fiscal space, but many other European countries don't. So fiscal space is an issue. But I think they will have to find ways, maybe through common European issuance, etc. You're right that interest rates are going up, in part because of the higher investment. And of course, the offset of not knowing, whether investment in other areas maybe go down a bit, that could be offset.
Understood. So let's just pull it all together. If this investment cycle does play out how you expect, which is essentially advanced economies spending a lot more money, what does that mean for the macro backdrop, for growth, inflation, the way that central banks think about policy over the next few years?
If things pan out as we think, and a cycle we see always as investment growth, right? You would expect that to accelerate. Typically, these cycles are about a decade, and they peak pretty much in the middle. So what you would expect is in the next 5 years or so, accelerating investment. What does it do? It means there's more demand for capital. And if, savings ratios don't rise immediately, you would think, what is the price for capital? It's interest rates. So that famous R star, that real interest rate, you would think could be higher. At the same time, and that is much debated elsewhere, is AI is, of course, potentially a huge pressure on wages. So you could see inflation, core inflation that's wage-related, to be weaker. Then again, what you will likely see is continued price pressures on commodities because it is commodity intensive. Energy and electrification needs copper. All these metals you've probably talked about elsewhere already, they may see continued price pressures. That's why people also talk about a commodity supercycle, which that seems to go hand in hand with that kind of a Capex supercycle that we're about to see.
Yeah. Christian, thank you so much. I spoke at the start about wanting a bit more perspective at a time where we're being bombarded by headlines. It's great to have you on and talk about this longer term piece because AI, defense, energy, economic resilience, they're so key in the market right now. And the numbers that you've written in the note are just so big. It's great to have you here.
Thanks, Patrick. Great to be here.
A couple of things that I'm going to be walking away from this conversation thinking about. Firstly, if you look back at 150 years of data, you can see that investment is volatile, but it does come in cycles. The typical duration of each investment cycle is about a decade, and the cycle shape tends to be symmetric around the peak. After 2 decades of subdued capital spending in advanced economies, we appear to be at the cusp of an enormous investment cycle, being driven not just by AI, but by energy security, defense, infrastructure, and economic resilience. And it's worth remembering these aren't cyclical decisions, they're strategic ones. They're being reinforced by the very shocks dominating today's headlines. So when you put it all together, by the end of this decade, investment to GDP ratios could reach or even exceed the levels last seen in the 1990s. Thanks for tuning into the Barclays Brief today. Do hit subscribe to stay up to date with the latest views of our thought leaders, and we'll be back again next week